Hi, I'm GK Srinivas, partner at the NorthStar CPAs. Welcome back to our channel. In this video, I will walk you through some of the most common tax mistakes we are seeing among individuals and families with financial connections between India and the US. Cross-border tax situation can get complicated, and some small mistakes could also result in unexpected taxes, penalties, or compliance burdens. So let's go through a few things that everybody should be in the watch out for. First, assuming income taxed in one jurisdiction is not taxable in the other. A lot of people believe that if income has already been taxed in one jurisdiction, they do not need to report it again in the other jurisdiction. For example, the US tax system works in a manner where global income is to be reported by all residents of US. If you are a US tax resident, green card holder, or a US citizen, you must pay taxes on your global income in the US. However, if you assume that just because you paid income from salary or house property in India, that does not to be included on the US return, the IRS is going to assess a penalty. Even if the income has already been taxed in India, in this example, it must still be reported on the US tax return. The next most common issue is missing reporting of FBAR and FATCA for all the Indian accounts. Many taxpayers forget that US requires reporting of foreign financial accounts, even if the incomes from these accounts are very negligible. If the total value of your foreign accounts exceeds $10,000 at any point during the year, you are required to file an FBAR, that is foreign bank account reporting. In addition, FATCA reporting may also apply depending on the value of the foreign financial assets and the filing status. If you want to understand this in more detail, you can check out our separate video on FBAR and FATCA reporting. Another mistake that we see frequently is not claiming the foreign tax credits correctly. When income is taxed in both India and in US, taxpayers often claim a foreign tax credit to reduce or eliminate double taxation. However, this credit needs to be calculated correctly, and the income categories must be properly matched between the two returns. If this is not done correctly, taxpayers may end up paying more taxes than what is necessary. Next is the incorrect tax treatment of Indian mutual funds. Many people are surprised to learn that Indian mutual funds are often treated as PFICs, passive foreign investment companies, and under the US rules, PFIC investments come with a complex reporting requirement and special tax calculations. And if they are not handled properly, they could end up paying higher taxes and penalties, as these compliances are to be met separately. We will also be releasing another video where we will be discussing in detail about the PFIC rules and the US tax reporting of these. Another common mistake is not reporting Indian rental incomes. If you own a property in India and earn rental income, that income should generally be reported on your US tax return. Many taxpayers report the income in India and assume that US does not require any disclosure or filing for this. Next is ignoring currency conversion rates. US tax returns and India tax returns require the incomes from the other countries to be reported in the local currency. As a part of this process, the appropriate exchange rates have to be adopted. And incorrect exchange rates, when they are adopted, may result in incorrect disclosures and tax filing. Another issue that we often come across is the incorrect residential status determination. Many visa holders generally tend to assume that their immigration status automatically decides their tax filing status. However, this is not the case in both India or the US. India's tax residency is determined as per the regulations of the Income Tax Act, and US has specific regulatory requirements as to who becomes a resident and who is a non-resident. So even if you're on a visa, your tax residency may be different than what you may expect. Finally, one of the biggest challenges in the cross-border taxation is a lack of coordination between the advisors in India and the US. Many individuals and families work with one advisor in India and another advisor in the US. But if the advisors are not aligned, it can lead to inconsistent reporting, missed tax credits, or compliance gap that becomes a tax burden. That's why having a coordinated cross-border tax strategy is extremely important. To wrap up, if you have financial interests in both India and US, it is important to make sure that your tax filings are properly aligned in both these countries. If you found this video helpful, don't forget to like, subscribe, and follow our channel for more insights on US India cross border taxation. And if you'd like help reviewing your specific situation, you can schedule a consultation with our team using the link in the description below. Thank you.